Japan has sharply reduced its U.S. Treasury holdings to $1.21 trillion as of May 2024, the lowest since January 2020, showing an 18.5% year-over-year decrease. This shift, driven by higher yields on Japanese bonds and increased hedging costs due to Federal Reserve rate hikes, marks a strategic move towards more favorable domestic investment opportunities. The sell-off raises the supply of U.S. Treasuries, potentially lowering prices and increasing yields, which could lead to higher borrowing costs and influence global interest rates. This trend may also incite volatility in global markets and prompt similar actions by other major debt holders. What implications might these changes in Japan's investment strategy have on the global economic landscape? Stay tuned as we explore the potential ripple effects in our upcoming segments. Japan's decision is partly aimed at supporting the yen, which has been weak against the US dollar. By selling US assets and repatriating capital, Japan can stabilize its currency. However, this action can also contribute to fluctuations in global exchange rates, affecting international trade and economic relations. A stronger yen can make Japanese exports more expensive, influencing trade balances and competitiveness. Japan's decision reflects a broader trend of diversifying away from U.S. Treasuries towards assets with potentially higher returns and different risk profiles. This shift may encourage other countries and investors to reconsider their investment strategies, potentially leading to reduced demand for U.S. Treasuries and increased interest in alternative assets, such as corporate bonds, equities, or real estate. Economically, the reduced holdings of U.S. Treasuries might indicate a strategic realignment of Japan's economic policies. Politically, it could influence U.S.-Japan relations, particularly in the context of economic cooperation and trade negotiations. As the largest foreign holder of U.S. debt, Japan's actions are closely watched and can have diplomatic repercussions. The global economy, already dealing with challenges such as inflation, supply chain disruptions, and geopolitical tensions, may face additional stress due to shifts in investment flows and currency valuations triggered by Japan's actions. These dynamics can affect economic growth projections and policy decisions across major economies. China has also been reducing its U.S. Treasury holdings. As of April 2024, China held $77.7 billion in U.S. Treasuries, down from higher levels in previous years. This reduction is part of China's broader strategy to support the yuan and diversify its reserves amid ongoing trade tensions, with the U.S.-China's strategic pivot includes increasing its gold reserves and investing in other assets to reduce reliance on the U.S. dollar. This strategy is also driven by concerns over potential U.S. financial sanctions and the desire to enhance the resilience of its financial system. The U.K., another major holder of U.S. debt, has been trimming its holdings as well. By April 2024, the UK held $10.2 billion in U.S. Treasuries, reflecting economic adjustments and strategic financial decisions. Countries in the Middle East, including Saudi Arabia and the United Arab Emirates, have also been selling significant amounts of U.S. Treasuries. Saudi Arabia's holdings have declined from a peak of $84.4 billion to around $111 billion, reflecting a cumulative sell-off of 35% over the past 2 years. The UAE has also reduced its holdings, further indicating a regional shift towards diversification and reduced dependence on U.S. assets. Other countries like Luxembourg and Canada have also reduced their holdings of U.S. Treasuries. Japan's decision to reduce its U.S. Treasury holdings could significantly impact the American economy, as Japan sells off a large volume of U.S. Treasuries. The increased supply could lower their prices and increase yields. This dynamic typically occurs when the supply outstrips demand, leading to higher yields. These higher yields mean increased borrowing costs for the U.S. government, potentially resulting in higher interest rates across the economy. This situation poses challenges for the Federal Reserve, especially as it contends with high inflation. An increase in Treasury yields might complicate the Fed's efforts to stabilize prices without causing a recession. Furthermore, a substantial sale of U.S. Treasuries by Japan could cause significant market volatility, potentially triggering a broader sell-off and destabilizing global financial markets. This volatility could lead to rapid price fluctuations, affecting investors and financial institutions worldwide. If Japan redirects capital to its domestic economy, boosting Japanese government bond yields, the yen could strengthen. A stronger yen might make Japanese exports more costly, possibly impacting Japan's export-driven economy and further influencing global market stability. The trend toward dollarization involves countries moving away from relying on the US dollar for trade and reserves, opting instead for assets like gold or other currencies to reduce risks from dollar volatility. This shift is underscored by developments like alternative payment systems to SWIFT and the adoption of central bank digital currencies, CBDCs, enabling trade settlements in local currencies. Japan, historically a major holder of US Treasuries, has reduced its holdings from $1.3 trillion in 2021 to below $1.1 trillion by 2022, reflecting a broader move to decrease reliance on US dollar-denominated assets. This trend is gaining traction globally as nations seek alternatives to the dollar amidst increased US financial sanctions and geopolitical tensions, potentially leading to higher US Treasury yields and borrowing costs. This strategic shift could diminish the dollar's dominance in global markets and reshape international economic policies. Japan's recent divestment from US Treasuries, signaling a wider reduction in foreign bond holdings, reflects strategic adjustments by its financial institutions to address domestic and external economic pressures. Key among these is the desire to offset substantial unrealized losses on Japanese bank balance sheets. For example, Norinchukin Bank plans to sell $63 billion in US and European sovereign bonds to mitigate losses totaling about 2.2 trillion yen by March 2024. This move is part of a broader strategy by Japanese banks to diversify investments and reduce exposure to interest rate risks from sovereign bonds. Simultaneously, Japan's Ministry of Finance has intervened in the foreign exchange market to stabilize the yen, which has reached a 34-year low against the dollar. Selling US Treasuries also supports the yen and manages inflation at home, crucial after decades of deflation. These steps, coupled with the Bank of Japan ending negative interest rates, aim to make domestic investments more appealing, though they lessen Japan's influence in the US Treasury market, potentially raising US borrowing costs. This situation highlights the complex interplay within global financial markets and underscores the significant role major economies like Japan play in maintaining global financial stability. Japan's prolonged economic stagnation, known as the lost decades, started in the early 1990s after a significant asset price bubble burst. This period is characterized by minimal growth, persistent deflation, and deep-rooted economic problems. In the late 1980s, fueled by speculative investments and easy credit, Japan's economy expanded rapidly until the Bank of Japan sharply increased interest rates in 1989 to curb inflation, causing a collapse in real estate and stock prices. This triggered a financial crisis and marked the onset of Japan's economic challenges. Policy errors exacerbated the situation, with the Japanese government and the Bank of Japan slow to react, heavily relying on interest rate cuts and delaying the resolution of bad loans. This, along with intricate relationships between economic bureaucracies and corporations, obstructed effective policymaking. Persistent deflation discouraged spending and investment, while policies like quantitative easing and negative interest rates failed to reinvigorate growth. Demographic shifts, such as an aging population, led to higher savings and reduced consumption, further weakening economic activity. Additionally, the rise of insecure, non-regular employment reduced labor productivity. External shocks like the 1997 Asian financial crisis and periods of strong yen also hurt Japan's competitiveness, exacerbating the stagnation. Collectively, these factors entrenched Japan in a prolonged period of economic inactivity, offering critical lessons on the impacts of policy decisions and demographic trends on national economic health. Recent monetary policies in Japan have undergone significant changes, especially with the termination of the country's long-standing negative interest rates. This shift marks the end of an era and introduces a new phase of monetary policy for Japan. In a notable move, the Bank of Japan, BOJ, recently raised short-term interest rates from 0.1% to a range of 0% to 0.1%. This decision ended Japan's 8-year period of negative interest rates, a policy initially adopted to combat deflation and stimulate economic growth. Negative interest rates were meant to encourage banks to lend more by penalizing them for holding large reserves. However, this approach had mixed results over the years, maintaining ultra-low rates since the late 1990s. The BOJ continues to implement quantitative and qualitative monetary easing, QQE, with yield curve control, YCC. This framework aims to achieve a stable inflation rate around 2%. Despite the recent rate hike, the BOJ remains committed to maintaining an accommodative monetary policy to support economic recovery. In its recent statements, the BOJ highlighted the need for flexibility in monetary policy to address the evolving economic conditions and inflationary pressures. Japan's inflation has reached a 4-decade high, with the core consumer price index, CPI, excluding fresh food and energy, rising to 4.1% in April 2024. This increase is driven by both global supply chain issues and domestic factors. The BOJ has observed signs of a more durable inflationary trend, suggesting that Japan might sustain its 2% inflation target in the medium term. This positive inflation outlook comes after decades of deflation and economic stagnation. How do you think Japan's reduction in U.S. Treasury holdings will affect the global financial markets? Join the discussion in the comments section below. Don't forget to become a part of the Revel Discovery community by hitting that subscribe button to stay informed about the latest economic trends and financial insights. Discover how these changes shape the future of global markets with us.